With the holidays in full force, we wanted to feature one of our holiday partners, the Salvation Army. Today, I'll be interviewing Lisa Young. She's the Director of Gift Planning for the Western PA Division, and we're going to talk a little bit more about charitable gift planning. So every year, Schneider Downs partners with Angel Tree through the Salvation Army. Can you tell us a little bit more about that program and how our viewers can participate if they'd like to?
We have wish lists from children that are shared with companies, churches, small businesses, individuals who go out and buy presents for the kids that we have in our program. It's a great effort because many kids that would normally not have Christmas presents on Christmas Day will have them because of this program. And last year we distributed about 100,000 toys to kids in the Western PA area.
It really is an amazing program. I've participated here at Schneider Downs and also through church in the past. And something we love to do is we have a 10-year-old daughter and now a 10-month-old daughter who will be participating this year. But we love to match her age, right? So we pick a 10-year-old girl, we'll pick a around 1-year-old girl too, and then let them pick gifts that they like for themselves. So it's a really great opportunity, I think, to get your kids involved and teach them about giving and thinking about others, especially around the holidays.
It's a great program. Everybody gets the Christmas spirit by being involved. And if anybody is interested in joining with us in this project, they can go on our website, salvationarmywpa.org/angeltree.
So if we shift to charitable gift planning, when we work with clients, we often help them plan their charitable giving during their lifetime and also within their estate plan. So during their lifetime, there's a lot of ways to give to charity. Can you tell us about some of the different options and the benefits of each?
Well, cash is always good. They get an immediate charitable income tax deduction if they are someone who itemizes their gifts. Also, I think one of the better things is appreciated securities, because oftentimes people have highly appreciated securities and they would have to pay capital gains tax on the stock if they cashed it in. But if they give it to charity, then they don't have to pay the capital gains, and neither do we, because we're a charity. Also, there are donor advised funds. I think that's a really good way, because you can put an amount in at the beginning of the year to a financial institution and then direct them to give gifts to charity throughout that year. The nice thing is they do the charitable income tax deduction right away, so they don't have to wait for each charity to acknowledge the gift. For people who are really wanting to support a favorite charity, they could continue those gifts even after they pass away with a succession plan.
When we're determining the best strategy to use, we are looking at, the taxation and deductibility. And we often use the donor advised funds. Let's say if a client has a large inflow of cash from a business sale, right? There's going to be a huge tax due on that. So if we can funnel some of that into a donor advised fund and get the deduction in that year, then they can, for their lifetime and even after their lifetime, like you said, use up those funds to one charity or to multiple charities. And then you also mentioned highly appreciated securities, which is another strategy that we use with clients, especially clients that have moved their assets to us under management, and they've transferred in really highly appreciated securities. And it's a great way for us to transition portfolios and just to help them take advantage of removing some gains year to year.
They can also do charitable gift annuities and charitable trusts. Those kinds of options are a nice way to get that money out of their estate so that they can utilize it during their lifetime. And then once they pass away, the gift goes to the Salvation Army in full. So the life income arrangements can be very beneficial to both individuals and to charity.
So most charitable contributions can't be more than 60% of your adjusted gross income. But in some cases, that's 20, 30, or 50%. Can you explain the difference between those limits?
Sure. It's kind of confusing, I would think, for the average person when they hear all of these percentages. And what we always recommend before any type of a big gift or something that the donor doesn't quite understand, to always check with their financial planner first to see where they fit. Overall, deductions to private to public charities, including DAFs, are 50% of adjusted gross income. It increases to 60% for cash gifts. And for appreciated stock, it's usually 30% of adjusted gross income in the year the gift is made. What's nice, though, is if you have an additional 5 tax years to be able to write off the gift. Another thing to consider is also now the standard deduction amounts for individuals and for couples has risen. So sometimes it's almost better not to itemize. It just depends on your situation.
So another way for clients to donate in their lifetime is through their required minimum distribution, which is the minimum amount you must withdraw from your retirement accounts each year once you hit a certain age. And people can use up to $100,000 of their RMD annually to donate directly to a charity, which is known as a qualified charitable distribution. So is there a tax benefit to this strategy?
I love using IRAs for charitable gifts because it's such a great program, and it's gotten better as the years have gone on. If you're 70 and a half or older, you could make annual outright gifts up to $100,000 from your IRA. Sometimes people don't really want to start withdrawing their IRA money. They don't really need it for their day-to-day living. They also might be somebody who likes to support charity. So this is a win-win for them because they won't have to pay the income tax. The thing that you have to remember is that because it's from an IRA and they never pay taxes on it, they don't get a charitable income tax deduction for that gift. But now, this year, you can actually take money out of your IRA and put it directly toward a charitable gift annuity or a charitable trust. Now, the rules are a little bit different than the outright gifts. That $100,000 that you're allowed for a year includes the outright gifts. So if you do a big gift for an annuity or a trust this year, then you can't do your outright gifts. But then the next year, you could start over and do the outright gifts up to $100,000.